Tick-tock goes the clock. And with every minute that passes, the United States deficit increases. And it does have an impact on your portfolio, your investments, your trading, your money. And I'm here to help you understand all of that. What's up, everybody? Jeremy Hritz here, and welcome to Courage Pays Better Than Fear Trading, where we are going to break down the deficit and how it has hit 7 to 9% of GDP in 2025 at the highest levels outside of a recession. And you may be asking, how does this impact your stock portfolio? Or how does it impact trading and investing? And I'm going to cover why it can help or hurt the market, what drives deficits up, how AI is stepping in to help, and what the solutions are to fix it. So let's jump into this together and understand the impact of the deficit. The US deficit is like a raging storm cloud over the stock market. It can cause higher interest rates because to cover the deficit, the government has to borrow money by selling treasury bonds. In 2025, investors are worried, and that's pushing the 10-year treasury yields to 4.5% or sometimes higher. Those higher yields raise borrowing costs for companies, they cut into profits, and they drag down stocks, especially growth names like Tesla or NVIDIA. So keep an eye on that 10-year treasury. That's important in terms of seeing what is happening in the markets. And it also crowds out capital because massive government borrowing soaks up money that could fund businesses. And this crowding out slows growth, and it really hits tech and small cap stocks the hardest. And there's market panic as a result of this. And this year, we see people freaking out about a potential debt crisis. And we saw recently Moody's downgraded U.S. credit, and that triggered a sell-off. So it's a real risk, but there's another side to this story. Believe it or not, a growing deficit can boost stocks in the short term. Think of stimulus. Deficit spending often funds tax cuts or infrastructure programs. And this pumps cash into the economy, and it boosts consumer spending, and it lifts stocks higher. And it also can fuel economic growth. And a strong economy with GDP growth holding steady in 2025, it often widens deficits as people buy more, including imports. And this fuels corporate earnings, and it pushes stocks higher. It's a short-term win, but like any sugar high, it can fade fast if the deficit spirals. So why is the deficit exploding in 2025, and what makes it shrink? The causes of increase are spending overload, social programs, defense, interest payments on $34 trillion. Those are massive costs. And then interest payments alone are eating up billions of dollars. Tax cuts, recent 2025 tax breaks like corporate reductions cut revenue and balloon the deficit. And then trade shocks, tariffs. We've talked about that how many times on this channel? Think of China's 34% tariffs on U.S. goods. Those disrupt trade and widen the deficit. Now, what could cause the deficit to decrease? Robust GDP growth boosts tax revenue, and it narrows deficits. Spending cuts, reducing non-defense spending. And then also, tax hikes could cause a decrease in the deficit. Raising rates on high earners or corporations increases revenue. That would not go over very well. Let's talk about this, artificial intelligence and how AI can help reduce the deficit. And here's why 2025 is exciting, because AI advancements are stepping in to help tackle the deficit. They are boosting productivity, and we're finally starting to see this. But think of those AI tools like those from Microsoft, Google. They are streamlining government operations. Think tax collection, fraud detection. And the Congressional Budget Office estimates AI-driven efficiencies could save $50 to $100 billion annually by 2030. And AI also powers economic growth. Industries like tech and healthcare drive GDP growth, and companies like NVIDIA are leading the charge, and they increase tax revenue as profits soar. And then also job creation. There's a lot of fear about jobs being replaced, but AI startups are creating high-paying jobs. They're boosting income tax revenue, and with the tech boom in AI this year, that could help shrink deficits if managed well. And so think of AI like a financial superpower, but it's only one part of the solution. So how can the deficit be tackled beyond AI? Here are some practical solutions. Capping spending, multi-year limits on non-defense spending could save billions, or increasing revenue. Targeted tax increases or closing loopholes, tax loopholes, can boost funds without stifling economic growth. You can grow the economy. Infrastructure or AI-focused investments drive jobs and tax revenue. Or reform entitlements. Streamlining Social Security or Medicare could cut long-term costs. And these steps are difficult. They are very controversial, and they require difficult decisions, but they are critical for the stability of the United States. So the U.S. deficit is a long-term challenge, but you can take control of your investments now. Diversify. Spread your money across ETFs like the SPY, the Qs, bonds, stable stocks to weather volatility, and stay informed. Keep an eye on deficit news. Keep an eye on AI trends. Inform yourself. Be educated. Know what's happening so that you can make the best decisions for your money. And subscribe to this channel so you can stay up to date of everything that is happening in the markets. And I'll see you back here for the next video.